Asia-Pacific markets showed varied performances on Wednesday. Indian stocks steadied following a significant decline the previous day as investors processed the outcome of the national election. In India, the Nifty 50 and the BSE Sensex all gained nearly 1%, recovering slightly after the previous day's sharp falls of about 6% respectively. These had wiped out $371 billion in market capitalization following the election results. Australia's first quarter GDP grew by 1.1% year over year, slightly below expectations, while the S&P 200 increased by 0.45%. Elsewhere in the Asia-Pacific region, and Japan's Nikkei 225 and the Topix shed over 1%, while South Korea's Kos-pi and the Kos-daq all made gains. To Wall Street now, where S&P 500 closed marginally up 0.15%, and the Dow Jones edged higher by 0.35%, bouncing back as fresh data showed job vacancies in the US slipped in April to their lowest level since 2021. Well, let's get more on this now with Naeem Aslam. He's Chief Investment Officer at Zay Capital Markets in Dubai. Thanks for joining us, Naeem. Now, how do the mixed performances across different Asia-Pacific markets reflect the broader economic conditions in the region? And what trends do you think investors will be watching?
Sure. Thanks for having me. Look, I think the data has clearly shown not that much of a good print because investors were expecting that, look, the RBA, they can afford to keep the rates higher, but everything is data dependent. And then that is what traders and investors have been looking at. If you look at the inflation situation over there, then of course, inflation is still continues to remain very stubborn. Now, traders like over in Europe and over in America, as the session began, they have a number of different things to look at. Number one is, of course, as you correctly mentioned, the massive plunge in the Indian stock market and what does that really mean going forward? Because this is for the first time in 10 years that BGP is not going to rule the country with the majority that it had. Number two is, of course, the numbers, the GDP numbers from Australia. And when it comes to central banks, the problem is the same. Inflation is still continues to be stubborn, and they wonder what they need to do in order to bring interest rates lower and bring inflation lower as well, while keeping a balance for that. And number three is, of course, the most important event for this particular week, which is the ECB event going to be taking place tomorrow. So investors are very much focused on what they have so far, how they're digesting it, and what is about to come to them in the midst of the massive gains that we have seen, especially for the US stock market. I know for Australian market or for a Nifty, which you correctly mentioned, it's pretty much erased all the gains. So traders are looking at what is next for the market and what central banks are going to do for the markets.
So you mentioned Australia's slightly lower than expected GDP growth in the first quarter. What do you think are the potential implications for the country's economic outlook and investor confidence in the upcoming months?
Well, I think, look, investor confidence is obviously shaken today because of the numbers that have come out, because RBA continues to believe that, okay, there's going to be no case for a hard landing. But now the GDP numbers have shown that, look, the case for hard landing is very much on the table. So investor confidence very much stems from economic data. It doesn't, and then the second most important thing is the reputation of these particular central banks, RBA, which continues to hold that, okay, you know what, we can hold interest rates higher for a longer period, plus the conversations within the members who think that, okay, maybe another interest rate hike is also possible, which, by the way, is also the conversation among the Federal Reserve, which could potentially change when we get the US non-farm payroll data. So I think for now, investors over in Australia, they are obviously disappointed by looking at the GDP numbers.